How's it going, everyone? It is October 23rd. It's a Tuesday at 8 o'clock, and it's webinar time. So, same setup as we've been using for the 365-day challenge. We're going to keep going with that because we're going to talk quite a bit about, what's going on in that challenge and some of the uses for that trading style and how you can make money with it. So once we make sure that the stream is all good to go, let's get started. So pulling up, we've got the two pages. We've got Tastyworks and we've got Thinkorswim. The reason I use Tastyworks is very simple. The commissions are far less than Thinkorswim. This is not really a promotion for Tastyworks, although I do very much like them. But having commissions from just a trading standpoint, if I'm taking 3 contracts or 5 contracts and it costs me $7 each way to buy and sell those contracts, that's $14 in commissions instead of here being $5 in commissions. So that right there gives you extra profit. So that's why I use Tastyworks. Everything else, chart-wise, Thinkorswim. I think I've got here, we'll unprivatize it. Where's the button? Here it is. Yeah, I have $5 in here. $5 with Thinkorswim, and I get all the real-time data. So if they're watching this stream, please don't take my real-time data away. So what happened this morning in trading? One, it was awesome. We walked away with $415 minus what, like 16 in commission, so that's absolutely fine. And how we're trading is very simple yet very complex. The simple part is it's 100% technicals, right? If you get an indicator that tells you to do something, you do what it tells you to do. What makes it challenging is the human aspect of it. I want to do this, but the indicator's not quite there yet, or the indicator's there and I don't want to do that move. And that's where the really challenging part is. So let's take a look at just our very first trade this morning, which was actually a loss out of the gate. So we'll zoom into our 1-minute chart, zoom into our 5-minute chart, and zoom into our 15-minute chart, which is right here. So we'll quickly go over what the trades were, and then we'll explain what each of these lines are, because there's quite a few of them. So right out of the open, right, we waited 15 minutes. Choppy, 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 choppy. It was pretty disgusting, right? This whole open was just awful. And then what we had at 9:45, which is right here, we had a very simple play. It was, we had a high, a lower high. The technicals say if you can't get a higher high, and it's overall a bearish day due to the gap down, that it should break down. So right here at 9:45, we bought puts. As you can see, we bought 3 of them, so medium-sized position for this account. And that cost us $507. We then got a bounce, looking at VWAP, that yellow line there, we'll discuss that more in a moment, and it basically popped. We got a move up, and it broke above that previous high of day, so we sold it at 9:49, which is exactly right there. Now, although that was the high, or the low in the case of put options, and it came back down here, we followed a very important rule. And there's 3 trades. The rule is very simple. You have 3 types of trades that you should be making. One is big wins. If you can make big wins, you're going to be profitable, right? That's how you make big money. The second is small wins. If you take a trade and it has a small win, covers commission, makes some profit, awesome. You do it again and again and again and again, and your account goes up. But the most important type of trade that you want to make, and that third and final type of trade, is called a small loss. And that's probably the hardest trade to make, because you want, one, when you're in the hole, like let's say right here, we bought puts here, it went down, and it came back up, right? We don't want to go, okay, this is going to come back down, we know it, blah, 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 it's going to be fine. We want to take a small loss. In this case, 169 to 144. If I pull up the calculator, although you can't see it because it's not part of the stream, 144 is our final price, so 144. 169 is our initial price. Divide by 169 times 100 is a 14 or 15% loss. I know you can hear the mechanical keyboard clicking away on that calculator, so you'll just have to trust me. It's a 15% loss. If I were to have held that, and this high, the new high of day, pushed up and pushed up and pushed up, this $75 loss that you see here would have gone into 100, 150, 200, 250, 300. And that hole that you have to dig out of gets deeper and deeper and deeper. The big misconception with taking losses is, there's a few ways I want to say this. One, taking losses is not a bad thing. It's really not. It's getting you out of a bad position. And by that double negative getting you out of the bad position, that makes it a good thing. Unless you're 100% in the hole, in which case you're already too far gone. So those three types of trades, right? Big wins, little wins, and little losses. So this first trade this morning was a little loss. We kept it little, 14%, little over that stop loss, but that's okay because we were testing this new high of day, and we sold it right at the high of day, but that's okay. And then it came back down. We were a little bit pissed off because that would have taken us back to break even or maybe into a profit a little bit, but that's okay. You clear your mind, you go, okay, you kept the stop loss, you were smart, you took the small loss, which is one of the allowable trade types, and you move on. So we'll move forwards here in the trading day, and we'll look at our next trade. This guy. We upped the contract size because our probability of profit went up because we had a nice move at the open after having, if we zoom out here on the 5 minute, after having one hell of a gap down, right? So the bears were in control for the morning. So
that was a nice move.
Right here, yeah, it really was a nice move. So at 9:57 a.m., let's grab the chart right here, 9:57 a.m., we got a move that, as you can see, there's that low, there's another low. This guy was market manipulation, which we talked about live during that trade. This sucker went pop, right down, and then came right back up within half a second. Huge market manipulation. They were trying to dump the market. If they would have been patient, it would have just come down by itself, but that's no fun for them. So this 9:57 move right here, you can see that candle went 1 cent below that previous low, and we went, all right, we're going to take our puts. Now, we were looking at a few different support lines, and we'll discuss those here. Let's do it on the 5 minute just for simplicity's sake. So this support line, this 270 spot right here, this goes all the way back to, I think we're going to need a multi-day chart here. Let's go to our SPY 1 day. That goes all the way back to here, to October 11th. So we said, okay, if the price breaks below that, this is going very, very far. And if we zoom out here a little bit more, you can see that next support line, which all of this we talked about right before the trade happened, the 268.48, that was our next point of support. So when it went from here and went 1 cent below, the next move, the next logical place that it could stop would be right here. So we decided, okay, we get that move, zoom back into it right here, right? We get that lower low. We're going to test this spot, this area, this 270.36. And anything below that is just disgusting. It's just movement all the way down to that 268.48. So we upped our position here. We went 5 contracts. We put it in, filled at 175, and a few minutes later, being, I guess, a few minutes being, 30, 40 minutes here.
Yeah, that's okay.
Yeah. 10. No, I guess just like 3 minutes. That was a quick one. All right, 3 minutes here. We had 9:57 to 10 a.m. Boom, 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 right here. It was rejecting a little bit. We were getting this wedge. It wasn't quite certain that we were going to get the breakdown. It was choppy, and we were in profit, 175 to 239. Nothing wrong with that. Let me pull up our calculator again. Although you can't see it, you can hear me click away. So our final price of 239 minus the initial price of 175 divided by the initial price of 175 times 100, that's 80% change, is 36.57%. So in 3 minutes, we profited $320. Now that's a lot. That's almost $100 a minute, and I will take that as a starting salary if anybody's hiring. $100 a minute, I would gladly take that salary. But that move here, we saw the low, we saw it break down, bam, 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 we took the profit. Very simple. Now the reason we took the 270 puts, as you can see 270 is right here. So we are one strike out of the money, pretty close to at the money, but you go out of the money a little bit, your delta's higher, your gamma's higher, and being a one-day expiration, it's going to be volatile, it's going to move. And if you don't know what delta and gamma are, please watch the Options 101 series. That'll explain a lot of what I'm saying here in a much more controlled environment that is step by step. So 3 minutes, $300. Nothing wrong with that. Now following that, we had at 10, can I extend this? It won't let me extend it. At 10 something to 10 something, it's really annoying. I'm going to break the stream here. 10:12 to 10:17, okay. Now it's back to normal. So 10:12 to 10:17. If we look at 10:12, that is right here. Not a bad spot, might I say. Right here, the reason I took this, we're going to zoom it over a little bit, 10:12, is because of this short-term EMA. This is the 13 EMA. I've been using it for just over a year now. August of 2017, July, August of 2017 is when I started using it. If it can't get back above this and starts curling over, I will see continuation on this trend, which is what happened right here. So at 10:12, we took entries on puts. It was very high probability again, so we took 5 contracts instead of 3 or 2. And at 10:17, which is right here, we took profit, which is almost the low of day. You carry it out 1, 2, 3, that triple bottom here. 10:17 is the low of day. So we went from here to here and from here to here. We didn't make the whole movement, right? We didn't want to get greedy and hold the whole thing. We just followed the trend. You get a move here, you get the breakdown, you take profit into the push. Move here, you follow the trend, take profit into the push. And then with that, another $170. So $415 on the day in total. Not bad. I'm going to pause here. If anybody has questions, feel free to post them in here. Alright, Mr. Zip, how do you decide the size of the position you take? Is it different for each trade, or do you have a general size? That is very important. Let's do some math. So, that's a great question. If you have an account, let's start with just $10,000. Make it very simple. If you have an account that's worth $10,000, the general rule to keep you from blowing up your account, because you don't want to do that, is to take a position that is worth 10% of your account. Right? If you lose the whole thing, you're only down 10%. That's important. That keeps you afloat, at least for another 9 trades if you're really, really bad at trading. So, you trade with 10%, and I have a personal profit target between 10 and 20% on the trade, because options are very volatile. Looking at 1 to 2 day options, some volatile days like today, you can make between 10 and 20% on your position. In this case, we had a loss of 15%. In this case, we had a gain of 35%, if I remember correctly. Let me pull up the calculator. Yeah, 36%. And then if we calculate the new one to 29 minus 195 divided by 195 times 100, that was 17%. So negative 15% here, positive 36%, and negative 17%, or positive 17% here. So with that, let's say you have a 10% position on the entire size of your account, and you make, let's say, 10% profit on that position. Well, 10% of 10% is 1%, and you've increased your total portfolio by 10%. So that is the general rule to keep yourself from sinking. Now, depending on how your chart is, how confident you are in the move, you can up that or make it smaller. So if we look at this position right here, or let's start with the very first position, which was the loss right here. Looking at this position, it was still pretty flat, pretty neutral. We had a channel going. Alright, top channel, bottom channel. So I took three contracts at $1.69 was worth about $500. So less than 10% of the account. So the confidence level was a little bit lower. but I wanted to take the opportunity. So I did. I took the 15% loss, calculate that into the less than 10%. It's about a 1.5% loss on the entire account if it were the full 10%, or about a 0.5% loss on the current account. So I can recover from a 0.5% loss. That's fine. For these two trades, these are higher probability, right? We saw this 270.36 mark from all the way back here on 10/11, on October 11th here. So we know that when we get a breakdown, like this guy right here, when it broke below here, bam, it was going to drop really, really hard. When it broke below here, it continued, right? And then it just kept going and going and going. But on those types of plays, breakdowns are my personal favorite. I'm a little bit of a bear. When you get those breakdowns, you can trade larger. So 5, about $875, still a little under 10% on the account, but that's okay. It's a larger position, about time and a half, price and a half worth there. So I decided, okay, higher probability trade. We know it's gonna crash here, and we didn't see the crash at the time because we're looking back in the past here. We saw this could bounce. It bounced here, it bounced here. So I'm going to take my profit here, and it's just fine. Solid profit, sold into a push. It wasn't the entire push, but we sold into it and took profit. That's what matters, right? Small wins. So that larger position is on a higher probability move. On this trade right here, this guy was 975, just about 10% of the account there, a little under, right, that 10,000 mark. So $975 on this bounce right here, 10-12. We knew this was going to continue down. The probability was very decent. It pushed, 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 sold. So that's why we use the higher position size. We use it 10% rule for just a very general trade, and then a 10 to 15 to 20%. I'd max at 20%. I'm not really comfortable putting that much money down on a trade unless I know exactly where it's going. But even then, that's a lot of risk. So
10 to 15.
Yeah, 10 to 15 is healthy.
Yeah.
So we'll pause here for a second. If you do have more questions, drop them in the good old Twitch chat. And in the meantime, we will move on to what is going on in this set of charts here, because there's a lot. So, one, I've got my monitor set up in two parts. I've got one of those fantastic LG ultra-wide monitors. So this is the right side of the monitor, this is the left side of the monitor. It looks a little weird because I've chopped it up for the stream. But I've got my trading on the left, right? Go in here, go to trade. Got the actual contracts that I'm trading right here. And I've got my charts on the right. When I'm trading, I have no account info, right? You see this little drop down. I keep that hidden because I don't care how much money I'm making or losing. I only care what the technicals are when I'm live. When I'm trading, anything that requires me buying or selling, I don't care what the profit or loss is because that distracts you. If you look at today's stream, you'll hear me say it quite a few times, and I think I said it at like 10:15, 10:16. I remember this very vaguely. I said, I wonder how much I'm up. And to figure it out, I just go to the account history, right? And I click it, but I was still in a trade. So it was either I close the trade and look at the P&L, or I keep the trade open and focus on the technicals. What I did, 10:16, we got a nice push here. Qs were starting to falter, and we'll take a look at that in a minute. Qs were starting to falter, and I said, okay, I'm going to close the trade and look at the P&L. So I clicked close, closed out the trade, and at 10:17 I went over here and went, wow, okay, that was $320. If I were to have been looking at this the entire time, or looking at my positions tab the entire time, I would see this number fluctuate. And that, as an emotional person, right, people have emotions and it decides how we trade, this messes with your emotions a lot. So I never go to this page when I'm trading. Positions, I don't think you'll ever see me go to the positions tab during a live stream, because I frankly don't care about what's going on in the account. I care about what's going on this single contract that I'm focusing on, and the single underlying stock, thus being SPY, executes, whatever we're trading that day. That's all I care about. I don't care about how much money I'm gaining or losing. I know if it's a gain or a loss because I bought it here, sold it here, whatever. I know where my break-even point roughly is. So that is step one. Don't look at how much money you are gaining or losing. And I won't look at the actual account size until the end of the day, until I've closed out these charts and I go, okay, I'm done. Right? That's when I will look at my charts. So what is going on this side of the screen now that we've covered the left side? This side of the screen, we're going to do something really cool really quick. TOS, full screen. I know this is going to break it a little bit. Ooh, I don't like that. Let's adjust this guy. There we go. So on this side of the screen, there's a lot going on. Let's zoom out here. Zoom out here. That's zoomed out enough. Alright. So this is where all the magic happens. This is how we figure out what is going on. We have a 1-minute chart, a 5-minute chart with after hours and pre-market here, a 15-minute chart, no after hours, no pre-market, and a 78-minute chart, no after hours, no pre-market. Now you're wondering why the 78-minute chart? It's a very good question. Most people use the 60-minute, but SPY is heavily algo traded, algorithms, right? You've got hedge funds with super smart quantitative guys. They're called quants. They do a lot of coding. They figure out what works. They test probability, and then they let a robot do the trading. Because as we discussed a minute ago, the emotional side of trading is what causes a lot of people to lose. So if you can let robots do it, then there's no emotion. It does what it's told to do. So the 78-minute chart, the reason we use that instead of the 60 is because of algorithms. And what I mean by that is our trading day is 6.5 hours, 9:30 a.m. to 4 p.m. Eastern Time. Mine's a little bit different because I'm in Mountain Time, but I keep my computer and TOS and everything trading-wise in Eastern because that's all that matters. So you take those 5.5 hours and you cut them into nice blocks of 5, right? These 5 candles here, those are 78 minutes apiece. Even 78 minutes, 5 of those is your 5.5 hours. Pretty simple. Or 6.5 hours, sorry, math is hard. And I only trade the first hour of the day, so whatever happens after that doesn't really matter. So you take this 78-minute chart, these 5 candles, and you break that down, you get 15-minute charts. 5 and 5 and 5 and 5 and 5 and 5 and 5. Pretty simple. 78 minutes broken up into fifths again. And that's another spot that algorithms use. 15-minute chart, very simple. You break that down again. You go into your 5-minute chart or you go into your 3-minute chart. I prefer the 5. It gives me a little bit of a clearer picture. If you divide 15 by 5, you get 3, or divide it by 3, you get 5. Pretty similar, but I like the 5-minute a little bit more. Zoom in here. And then if you take those thirds, if you were to use the 3-minute chart and you divide that down, you'd go into your 1-minute chart, which is right here. So that's the breakdown on time. Now, all the indicators. The most important are these 2 lines right here. This is a 13 EMA. This is a short-term indicator, short-term moving average, exponential. And right here is a medium-term moving average, a simple moving average. This is the 20 SMA. These 2 together work wonders. I could turn everything else off on this chart and just trade with this, and I would do decently well. We've done a lot of algorithm testing. Chris TM, our algo guy, he's done a lot with 13, 20. I think he developed it actually, and then some other guy stole it and is trying to teach it online for a profit. But this 1320, it's very simple, which is why I'm just telling you in a webinar. You get a short term that tells you where the short term move is, and a medium term that tells you where that medium term move is. If the short term is going faster than the medium term, you get a movement. And on this guy, if we zoom into right here, you can see that our breakdown starts to occur. Our short term curls down, our medium term goes from flat to curls down, and we get a breakdown. Once this crosses, we have determined that the move is clearly over, and it could go bullish. And if we went into Discord and looked up the alert around 10:20, you would see a very simple alert that says, hey, this trend is over, it's looking to go bullish, and then it did for the rest of the day. But when you get that cross, or when both of these start to go neutral again, right, when they go flat, that move is clearly over. So from just trading on those two indicators, you can do quite a number.
So you have a 13 and a 20?
13 EMA and a 20 SMA. Pretty simple. I like it. It works very, very well, and I haven't been too tripped up when just using that. Now, there's some other factors that we can get into, right? Volume and support and resistance. But the 1320 tells you where that overall move is going. Next is this yellow line, and it's only on my 5-minute and my 1-minute chart. This is VWAP. I'm sure you've heard of this before, that volume weighted average price. This tells me where the volume is coming from and where it's going. You see a lot of VWAP traders that go, okay, the price is bouncing off VWAP, it's going to continue up, and 9 times out of 10 it does, and that's why it's so effective, especially on like your small cap trades. That's what Wingfield does, that's what Jeff does, that's what Jay does. They're awesome indicators, right? VWAP tells you where the volume's going, and you can see exactly how much volume is down there. So by using VWAP and using my 13 and 20, I can get a little bit clearer picture of what's going on. I can see right here, we're sitting at an average volume. Nothing's really happening, right? Open, goes down, up, right to VWAP, down, up, right to VWAP, up, down, right to VWAP. Notice it's stopping at VWAP and stopping at that 20 SMA. Goes up, back down to VWAP, goes up, fails, and then it finally deviates from VWAP, and that trend starts. And you'll see that a lot with breakouts, right? If we flip this chart upside down, it deviates from VWAP, you get a huge push. So that's how we use VWAP. It's saying, okay, where is our average price? You can see it stalled right at VWAP here. Deviate from VWAP, comes back to VWAP. Deviates from VWAP, tries to come back to VWAP. Our 20 SMA holds a little bit stronger because the bulls took over, and you have a move to the previous high of day, that opening range there, and then it continues up. But that tells us exactly where that volume is and that average volume. The next spot, we're going to actually hop over to this chart because it's a little bit clearer to see. This is an opening range and yesterday's close indicator. Very simple. I can give you all of these if you'd like. They're great indicators. What this guy does is you have yesterday's close right there, and you have this morning's open right here. As you push into that zone, this shaded region gets smaller until you eventually break through it, or you just don't get to it anymore. You can see right here you pushed into that range, try to gap fill, and then it deviates, and this is your resistance to the high of day. So it's one great indicator to show you what the high of day is. So you can go, okay, if we get here and we push into high of day, we're likely going to get continuation up. Pushes further, further, further. All of that is bullish momentum. So this indicator is our gap to fill, shows us yesterday's close, today's open, and then how far we push into that gap. The next one here, this is our high and low indicator. This shows us the high and low of the previous day. So if we zoom out, we use this chart here, the 78-minute. You can see here's the high corresponding with this right here. Here's the low corresponding with this right here. That tells us the range of yesterday without going back and looking at that chart. You can see here it is again, high, low, right about here. Previous day high, previous day low. That one's kind of hiding under that support. But same deal all the way back, so you can get an idea of where it's moving. If we get a gap that is way below the previous low of day, one, it's going to want to get back into that normal range, which it almost held into today. So that's another way of using a gap to fill, right? Pushing up, back into the previous day's range. And if we open within it, that continues to act as a channel. It's kind of what happened here, right? Previous low of day was here, opened, dropped, came right back into it. So it's just another way that we can see where might the price hang out. Then the very last indicator, which I only use for very select spots, is our support and resistance. These red and green lines tell us over the last X amount of candles, I don't remember the exact number, but we'll pull it up. Oh, where is it? Support and resistance here. Over the last 10, there it is, 10 candles. Bottom line, top line, red and green. That tells us over the last 10 candles, if it hasn't broken through that, it becomes a support. And over the last 10 candles, if it doesn't break above that, it becomes a resistance. So that gives us an idea of where can we take those put options? Where can we take those call options for the breakout? So right here, this is our support. It breaks, but this is market manipulation, so ignore it. This guy breaks down. We're getting movement. It can't hold that support anymore. Solid bearish candle and a move down. So that's all that is. Support and resistance. I'll check to see if there's any messages. Awesome. No questions at this time. And now the last and most major part of this chart is kind of what's screaming at you the whole time is why are all of my candles blue? Why don't you use red and green candles? Why don't you be a normal trader? What are you doing? There's a very important reason for that, and this is the last point I will cover here. When you're looking at red and green candles, or me personally, I won't speak for you or any other trader here, but when I'm looking at red and green candles, that tricks my emotions. Right? We talked about emotions a little bit at the beginning. If I'm trading and I see my P&L or I see my account fluctuate, I get a little spooked. Right? Not bad. So I get a little spooked, my trading adjusts, and I make bad decisions. Same thing goes with red and green candles. If I see a red candle, like let's say, we'll zoom in here. See, I see this red candle. This, if it's red, indicates stop or indicates bad, right? Red is a bad color. Red indicates stop, stoplights if you live anywhere in the world that has stoplights. So that's a bad thing. But when I'm trading calls and puts, I have no directional bias. I don't care if it's a good or bad move. I only care if it goes up or down. So by having blue and blue candles, one, this blue is super soft, it's super calming, so you're not playing with your emotions there. But you're bullish and bearish, right? Instead of calling them red or green candles, because red is bad, green is good, green means go, whatever, right? Instead of having that red or blue, red or green, we have bullish or bearish. And when I'm trading, we bring this back down, go back over to our stream, right? When I'm trading and I've got all this open, and I'm looking at this, and I've got a put position open, right? I've bought 5, 10 contracts, whatever, and then I see this go, and this is red. Red is bad, and I go, ooh no, right? Emotion kicks in. Instead of it's going bearish, and I'm bearish because I bought puts. So it keeps you a little bit level-headed. I'd recommend trying it. It's weird. It'll take a little while to get used to, but then you'll forget that red and green exists, and this chart will just look normal to you. You'll see a lot of funds that have blue line charts just to get an overall direction of the day, right? They'll have whether it be like a whole bunch of monitors up on a wall in the main area or on a personal computer, they'll have blue line charts. And it's a very similar reason. You have no motion, it's either going up or down. If you don't have a position, it's not bad or good, it just is. That's what the chart's doing that day, that's what the price is doing that day. So that's how I adapted that chart, my chart, for that emotionless trading. It's going. I don't care if it's going up or down, good or bad, it's going. And you want to follow that with your trading. So I'll check to see if we have any questions here at the moment. I'll pause for just a minute, let you get those questions in, but that's it. That is how I trade. It's kind of simple, kind of complex. The simple part is there are technicals. Follow them, right? If it's saying it's going to drop, it's going to drop. If it's saying it's going to break out, it's going to break out. What makes it so hard is it going to break out? Is it faking it? Is it going to double top, triple top, and fail? Is it going to get attacked by some tweet? Is it going to get attacked by an FOMC meeting? All those outside factors, right? Ignore them. If it's going up, it's going up. If it's going down, it's going down. And most importantly, If it's not going anywhere, don't do anything, right? If we go back here, the first 15 minutes of the day, I did nothing. It was, yeah, it's pretty bad, right? You just sit here, did nothing.
Super flat.
Yeah, super flat, there's no trade. Let me check for messages, questions. Alright, the last thing I will talk about. We're going to go to yesterday. Yesterday was really bad. I don't want today and yesterday. I want just yesterday. Fine, we'll do a custom. What was yesterday? Yesterday was the 22nd. 22nd. There's yesterday. What is different about this day than today? One, there's a lot more trades, which is a big no-no. And two, it's negative. And three, I was making larger and larger positions. If we look here, 500, 500, 700, 700, 700, 800, 1,000, 1,000. The price or the position size kept going up, even though I was technically digging myself into a hole. This is bad trading. I'm showing you this not because I'm proud of it. God, no. Days like this are not fun for anyone. But to show you that, hey, not every trader is perfect. God, no. Nobody's perfect in trading, right? You want to be mindful when you get days like this. I mean, go watch yesterday's stream. It was disgusting. I kept the stream up there because it's a reminder to, one, me, don't do that. You look stupid. And two, when you do that, you lose money. And nobody likes that. But we kept it under 1% of the account, right? $100. Is that 1%? Can't do the math. I think it's 1%.
Yeah,
so, yeah, we keep it under a 1% loss on the day. You can come back from that. If it were 10%, that would hurt. And you'll see a lot of newer traders that will go in, they'll buy directional positions, and they'll hold, especially in options, they'll hold those positions, and it will hurt. They'll take a 20% hit on their account because they use 60% of their account. Don't do that. You'll find out that it may work once. You may double your account in a day and it'll feel cool, but the next day you'll think you're awesome, and you'll use double that account, right? Your new account size, 2 times what it was yesterday. You'll use that full thing, and then you'll take a 60% loss, and you'll be further back than what you started the day before. So keep it small, and you will make gradual increases to your account. Yeah, this is gross, right? Nobody likes this. Especially looking at today, right? We had 3 trades. 2 of them were profitable. A big win, a small win, and a small loss. Let's look at this one. That's a loss of 39. Small loss. That checks off. This guy right here. This is a small win. I will take it. That's a good trade. Right here. Small loss. Less than 0.5% of the account. That's okay. Small loss. A little bit bigger. Notice it went from negative 30, negative 40, negative 60. We're getting on a bad track here. Go to the next trade. Small win. A little bit into the big win. Big win is when you get above $100. In this account, it really does depend on what your account is, what you're trading, right? If we go, we just looked at this one, right? 1, 2, 3.
I stop after a loss.
Yeah, some people, it's better that you stop after a loss. If you take that loss, then just enjoy it and be happy that you could put down the computer. It's hard.
Yeah, it is.
If we look at this trade, small loss. I will take that. What is that, a 2-cent loss plus commission, so a 3-cent loss? Yeah, that's fine. This guy, this one, nope, that's not a trade. I'm like, this doesn't add up. This guy right here, 120. Now we're getting into really not good losses. Anything over a $100 loss is not something you want to do, especially in this account, right? That's more than 1%. And then this guy right here, we did end the day with a little bit of a pullback there. But I broke the rule right here. Not this one. Yeah, this one right here. I broke the rule, right? I took a big loss. Don't do that. Stop right here. Stop in this range when you start seeing your position size get larger and larger, right? 3 contracts, 3 contracts, 4 contracts, 4 contracts, 4 contracts, 4, 5, 5. It just kept getting larger and larger, and for no good reason. So stop when you can't control that. Ooh, I see another trade, I see another trade, I see another trade.
There will always be trades.
Oh yeah,
Literally always. It's
there's
amazing.
always a trade. And
But
let's go through the day of what actually happened on the account. So starting, $40 loss. That's fine. Nothing wrong with that. We made another trade. Down $3. Okay. Pretty much break even. Pulled a little bit out of the hole. $51. We're heading in the wrong direction. If we look at the set right here, up, down 30, up a little bit, back down, kind of looks like this. Down for the day, getting some recovery, and then it falls off a cliff. And then it got worse, down 111. And then it got a little bit better. We should have stopped right here. If I get within $50 of my break even and it's a bad day and I don't know what's going on and I'm trading all over the place, that's where I should stop. And then it got a little worse and a lot worse, right? That's a no-go, right? We don't want to do that. And then we brought it back a little bit within that 1%. So down 159 to down 79. With commissions is about $100. So into that 1% range. So that's what happened yesterday. No, I'm not proud of it, but you damn well learn from it. And then, I don't know why I'm going to unselect all those. We'll just go to today. Learn from days like that and come back the next day and kick ass, right? We lost $110 with commissions yesterday. We regained $415. That's what you want.
there you go.
Learn from yesterday, make it up today. Let me check to see if we have any questions. Otherwise, we're going to end it there. I will be back tomorrow morning, Tuesday at 9:25 a.m. We'll do another set of trading. We may make a trade, we may not. We can look at after hours right now. Kind of flat, bullish close. Little sneak peek of what we may be seeing tomorrow. So, looking at I want to turn off the price marker here. Looking at this, bullish move, bounced hard within like 5 cents of that previous low, came back up below or above this guy, and now went up into the previous day's range, closed strong. So if we pull up /ES, our SPY futures, still a little bit bearish, but that recovery is amazing for today. So we'll see what happens tomorrow. If there's a good trade to be had, we will take it in that first half an hour there. And we will learn from the mistakes of Friday. No, not Friday. Monday. What was yesterday? Monday, yes. We'll learn from those mistakes and not do that. So that's what we're looking at. This is VWAP. I don't know why. No, this is not VWAP. What is this? Oh, that's open interest. Yeah, we'll ignore that. So that's what we've got. I want to thank you guys for spending the last 45 minutes with me. It's been wonderful to kind of explain what's going on. If you weren't live, of course, if you're listening to this live, this doesn't apply to you. But if you weren't listening to this live, feel free to ask me any questions that you may have in chat or on just a morning live stream, because I'm always around Monday through Thursday. And I think we'll end it there. So I want to thank you all for joining us. We'll see you live in chat tomorrow morning. Wingfield has the stock side. I've got the option side on the live stream. And yeah. Do you have anything to add, Mr. Wingfield, there?
I don't. That was very good. I'm excited for see how SPY does tomorrow, and we'll make sure that we keep that discipline.
Yeah, discipline is the hardest part. It's the hardest part of trading, the emotion side of things. So, thank you all for watching. I will see you tomorrow morning.